This week on Wealth Track, the emerging markets are under fire as investors flee their markets and currencies, fearing an outbreak of financial war. But this week's guests, Matthews Asia's Teresa Kong and Lumisale's Peter Marber, say not all emerging markets are losers. They point out the victors next on Consuelo Mack Wealth Track.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Lumisales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Buy when there is blood in the streets, counseled Baron Rothschild in the 18th century. Buy in periods of maximum pessimism, advised Sir John Templeton in the 20th century. Warren Buffett still recommends being greedy when others are fearful. Well, all of those descriptions could apply to the emerging markets in recent weeks. Investors have been fleeing anything related to them: stocks, bonds, currencies, actively managed mutual funds, index funds, and ETFs. As a wise money manager friend once told me, the term emerging also seems to mean they periodically have emergencies. Some of the 50 so-called emerging markets are having fiscal, economic, monetary, and policy emergencies. Turkey and Argentina come to mind, but others like Singapore, Mexico, and South Korea, for instance, have strong fundamentals, yet they get tainted by the same brush. While investors don't seem to be differentiating among them, this week's guests do, and say investors should too. Teresa Kong is portfolio manager at Matthews International Capital Management, where she manages the firm's Asia Strategic Income Strategy. Among her responsibilities is managing Matthews Asia Strategic Income Fund, which she helped launch in late 2011. And prior to joining Matthews in 2010, she was head of emerging market investments at Barclays Global Investors, now known as BlackRock, where she founded the Fixed Income Emerging Markets Group. Peter Marber is head of emerging markets investments at Lumisales, which he joined just last year. Prior to that, he was chief business strategist and senior portfolio manager for the emerging markets group at HSBC Global Asset Management. A professor at Columbia University, he has written several books on emerging markets and globalization, including Seeing the Elephant: Understanding Globalization from Trunk to Tail. I began the interview by asking Kong why the traditional view of emerging markets is no longer valid.
Well, the emerging markets today are really so different from the emerging markets of 20 years ago. In fact, some countries have actually emerged, while several have not emerged. So maybe just to give you a personal example, my parents decided to emigrate from Hong Kong to the United States back in 1980 from Hong Kong. And back then, Hong Kong was making 60 cents for every $1 of GDP in the United States. And of course, my parents thought, well, US is a land of opportunity. But fast forward to today, Hong Kong is actually making $1 for every dollar that the US was producing in terms of GDP. So Hong Kong is at parity, which meant that over the last 25 years, Hong Kong actually grew at a much greater rate than the United States. And that's a really great example of how many emerging markets have actually emerged. But nevertheless, they're still being lumped together with other markets that are still trying to emerge. So I just wanted to highlight really the heterogeneity of it. And from the investor's perspective, the key here is to make sure that you're not involved in a passive strategy, because then you will end up having a benchmark exposure, if you will, that may actually be underallocated to the countries that are much more strong in their fundamentals.
Right.
And so you just want to make sure that you have active exposure.
So it's interesting because Teresa had told me at a phone conversation earlier that you should basically blow up the benchmarks.
That's right.
So Peter, the same question to you is, what about why should we ignore the indices in emerging markets?
Well, I mean, first thing you have to remember is you're talking about 85% of the world's populations sort of live in emerging markets, and you've got all different types of economies. You've got everything from exporters of bananas and stuffed animals to manufacturers of pretty sophisticated medical devices and everything in between. And what's interesting is that you've got GDPs that are 1,000 or 2,000, and then you've even got some countries that have GDPs per capita that are approaching 20,000, which is actually above the emerging market threshold as defined by the World Bank, and yet they're still in the indices. And I think if you looked at the currency indices, the bond indices, and the equity indices, what you'd find is completely different country weightings. And
so you gave me this fascinating fact, which is that in the MSCI Emerging Market Index, which is kind of the benchmark for everyone, it is that 43% of the index is made up of just 3 countries, so China, Korea, and Taiwan. So there's an example of, so you're buying basically 3 countries when you're buying that index, and you think you're spread out over all of these quote-unquote emerging markets.
Exactly, and those 3 countries have relatively limited weighting in the debt indices and the currency indices. So, you really actually have to look at multiple indices and multiple strategies to get what I'd call like the complete emerging market opportunity.
But what about, from returns, correlations, all of the things that we look at as fixed income investors, as equity investors. So, Peter, what do they offer as far as those other considerations, investment considerations?
Actually, everything you just mentioned. If we look back at least, let's take from 2000 through 2013, an investor who would have diversified a portion of his bond portfolio, for example, in emerging market assets, would have probably made about 4 or 5% more per annum than they would have in just U.S. bonds.
That's huge, and that's in bonds.
That's in bonds. You probably would
Right.
have made around 4% more in equities. And you mentioned correlation. Most of these markets are actually, their economies are not that correlated to those of the US, and their markets are not that correlated, meaning they're zigging when we're zagging. And one of the great things that we can do today as investors is invest globally in a way we couldn't do it 20 years ago. I mean, if you look at the amount of ETFs and actively managed funds for emerging markets, an individual today can globalize their portfolio the way some of the largest pension schemes in the country can. It used to be only institutional investors could really globalize their portfolios, but now individuals can do the same thing.
So there's been a great equalizer in your investment opportunities, but that also means that you've really got to know what you're doing. Teresa, one of the things about the emerging markets that everyone talks about is that their volatility. So how much of a concern is that when we consider investing in emerging markets?
Certainly, volatility is a concern if you're investing for 1 year. But I think most of us have a much longer term investment horizon. And from that perspective, it really does make sense to diversify. And emerging market equities have actually proven to produce good returns over the long run. There is reversion to the mean. So if you have the 3 to 5 year investment horizon, most likely this is not a bad entry point into emerging markets, especially into Asia equities.
So where are the opportunities in equities in a space other than Asia?
Well, actually, the entire index right now looks very, very cheap. I think price to book is only about 1.5 times. I think
this is the MSCI Emerging Market Index?
Exactly. Yeah. Forward-looking earnings are about 10 times versus, I think, 16 for the S&P. So you're getting at a discount, and Teresa made a good point. Historically, the relationship between the MSCI has always traded at a little bit of a discount relative to like the S&P, but it's probably more like a 20% discount, and now we're down to, I think, around 33%. So timing does always help in investing, and actually, if you could accumulate exposure when markets look cheap.
So the fact is that it's a lot trickier and more dangerous to be in these markets still, right? Because of their lack of liquidity.
In the short term, I think, yes, I think that's the case with most emerging markets or even small cap companies here in the US.
Right.
But again, it's important to make sure that we don't just invest in large capitalization weighted indexes, because that also has a different bias. So for example, like in case of China this last year, China, the overall index really underperformed the small cap China index by double digits. So I think that investors need to think about the type of risk that they like to take on and make sure that the returns that they're getting are commensurate with that level of risk.
So Peter, what do emerging market bonds represent to me as a bond investor?
Well, first of all, there are two types of bond investing in emerging markets. One is buying dollar bonds with credit spreads where you're earning a premium over what you would get.
And explain what a dollar bond is.
Oh, it's, let's say, the United Mexican States. The government of Mexico is issuing bonds actually in dollars, which is different than if they issue them in Mexican pesos.
Right.
Your return stream would be very, very different. Now, what's interesting right now in emerging market dollar bonds is that on average, you can probably get anywhere from 1% to 2% more from an emerging market issuer, a company or a country, relative to the exact same rating that they have in the US. So in investment grade right now, I think it's about 100, 110 basis points more that emerging market corporates are actually paying than US corporates with the exact same credit rating. And in the higher yield space, as we go down the credit spectrum, actually in some cases are paying maybe 200 basis points more.
Right, 2 full percentage points, which is huge
Which
in a
is
low
huge
interest rate environment.
in a very low interest rate
Right.
environment. And I think that most people don't realize that actually for the last 14 years, emerging market bonds actually outperformed emerging market equities. In fact, the two leading emerging market bond indices are among the best indices of anything in the world for the last 13 or 14 years.
And to the point that Teresa and I were just talking about is the volatility. What about the volatility in emerging market bonds?
That's a really great point. It's probably half or less than half of what equities has been. So it's been really one of the great risk-reward trades in the last decade or so, meaning you've gotten relatively high returns, roughly around 10% a year for the last 14 years, and the volatility has been less than 10%. I think equity returns have been more like 8 or 9%, and the volatility has been around 25%.
And how does the volatility compare to the equivalent, credit rating issue in the U.S.? I guess that's
it's definitely a little bit higher.
Yeah.
But at least you're getting compensated for that additional volatility. And we should mention that even though emerging market equities have been much more volatile, let's say, than the S&P for the last 14 years, it's also outperformed by 4 or 5% a year on average. So you've been compensated in debt and equity investing in emerging markets by getting extra return. So we should make that clear that it's not been a lot of extra volatility for nothing. You've actually
Right.
been compensated.
So go ahead.
And maybe one important point, we talked a lot about history. I think one of the biggest concerns on investors' minds right now is what to do when interest rates in the U.S. are rising.
Right.
We're at the end or close to the end of a 30-year interest rate cycle where rates have continuously fallen. And so one consistent concern that we always get from our clients is, how do I get yield without taking on too much risk? Well, what we do know about emerging market bonds is that while it does have some correlation to U.S. interest rates, it does provide a source of diversification. And going forward, we're also going to be able to pick up some yield from that. So yes, there is a trade-off. You are giving up some volatility, but you are going to have less correlation to rising U.S. rates. And in addition to that, you are picking up good yield from the increase, the risk premium and the credit spreads.
So let me ask you, because as portfolio manager of the Matthews Asia Strategic Income Fund, so where are you finding strategic income, and what does strategic income mean?
Yeah, that's a great question. The way we look at our portfolio is that we have the ability to invest across currencies. As Peter mentioned, there are bonds that are denominated in their local currencies, but there's also bonds that are denominated in hard currencies, the US dollars, euros. So we can invest across currencies. We also have the ability to invest across what we call the capital structure. So that means being able to invest in senior secured bonds all the way down to convertible bonds. In fact, sometimes dividend yielding equities. And so that enables us to really do relative value across currencies and up and down the same company.
So where are you finding the best strategic income these days?
Yeah, right now we are seeing some opportunities in the US dollar denominated debt of high yield, or in other words, sub-investment grade bonds. And
the high yield, this is not government debt, this is corporate debt, but there's high yield emerging market corporate debt.
Yes,
So that's
it's-
where you're seeing some opportunities.
By and large, a lot of these are corporate debt, but also some government debt. We really specialize in corporate debt because it really enables us to broaden the diversification. If you're just investing in countries, there's really a couple dozen countries.
Right.
But once you broaden it out to companies, then there are several hundred companies that we could be looking at, and diversification is a good thing. But just back to your question, we are seeing value in the sub-investment grade universe of some US dollar bonds by Asian issuers. So that's one area. Another area that we've been slowly adding to is Indonesia.
Mm-hmm.
Last year, Indonesia has been hurt both by the tapering in the United States,
Right, the Fed tapering, right.
that have translated into greater volatility for all risky asset classes, as well as some domestic inflation. But we really feel that currently a lot of the bad news has been sufficiently priced into the securities.
So, and are these Indonesian government bonds or Indonesian corporate credits?
Both.
Both.
Yeah, the rupee is down almost 30%, I think, from peak last year. It's definitely poised for a bounce. We're pretty constructive on it as well at Loomis. And I'd also echo the attractiveness of the high yield sector in emerging markets. I particularly like the double Bs, which is very close to investment grade. I mean, right now on average in emerging markets, you can pick up about 420 basis points above U.S. Treasury.
Again, that's more than 4%.
More than
right.
4.2% more on average
Right.
per annum than Treasuries. What's interesting is that U.S. high yield single B rated companies are paying just about the same premium, meaning actually in emerging markets, a double B,
Right, you get a better
You get a
credit.
better credit
Right.
for the same spread that you would get in a U.S. junk bond.
But it was interesting when Peter and I had talked earlier that you said when you want to take multiple strategies.
When I say globalize your portfolio, I
Yeah.
really mean globalize your bonds, globalize currencies, globalize your equity exposure. You now have the ability to invest outside the U.S. stock market and outside the U.S. dollar. Why not take advantage of the 60-odd countries that are growing much faster than the U.S., where markets are much less efficient, lots of assets are undervalued.
So as far as fixed income opportunities are concerned, that Teresa just mentioned a few. So and you said that you agree with the Indonesia that that's an interesting place
The
to look.
rupee is definitely an interesting place.
Is there another market that comes to mind that you think looks particularly undervalued right now?
We've been pretty active in what I would call a lot of non-correlated markets, African plays. We've been in places like Uganda, Kenya, Nigeria, Uruguay, what we would all typically call the frontier markets. Teresa and I both been in emerging markets long enough to remember that these actually look like what emerging markets really were like
Right,
20 years ago.
20 years ago.
These are countries that have not emerged yet. They're sort of still in that developmental stage. What's interesting that a lot of their currencies are not really hinged on what's going on in Europe or what's going on in the US or what's going on in Japan. And so they really are an interesting additive to a portfolio.
And again, you're looking at bonds.
We're looking at,
from these
in those countries, we're actually
government
looking at
bonds?
government bonds
Right.
denominated in the local currencies. They're typically paying much higher interest rates than what we're getting in the US, Europe, or in Japan, which is near zero.
And you're not worried about default.
We're not worried about default. In the case of local currency, what you worry about more is the foreign exchange rate. So you're not worried that the government won't pay their bonds back. The question is, what's the FX rate going to be
Right.
when you want to exit and get out? But those are a few markets that we've found, at least in the last year or so, that things are pretty stable.
One investment for a long-term diversified portfolio, which I always ask our guests at the end of every program. So what would you have us own, Teresa, in a long-term diversified portfolio?
I would actually recommend that everyone add and complement their portfolio by having Asia frontier markets.
Asia frontier markets.
Absolutely.
All right.
On the equity side.
And they are, what are a couple of the Asia frontier markets?
Places like Sri Lanka, Bangladesh. These are frontier markets that are not correlated to even the emerging markets. And echoing what Peter had said, they offer many opportunities that we may not even have any access to if we're just investing in the U.S. companies, because U.S. companies are much more much more invested in the export sector, for example. Whereas a lot of these countries, what we're talking about is the growth of the middle class. And it's really the smaller local companies that have the most exposure to that sector.
And what would your one investment be, Peter?
Well, if we're looking 10 or 20 years out, I think I would probably make an interesting bet on India and Indian equities. But what's interesting is when I say go into Indian equities, remember, Indian equities are denominated in Indian rupee.
Right.
And the rupee is actually very undervalued. It's one of the cheapest currencies in the world, according to the World Bank. Much cheaper, actually, on a theoretical basis than the renminbi, which is actually revalued about 30-odd% in the last decade. India is interestingly about a generation behind China in terms of infrastructure development, in terms of human capital. So I think there's an enormous potential for productivity growth in that country. So if I had a long-term punt, I think that's where I'd
All right, and
put some money.
Indian equities.
Indian equities, because as I mentioned, you'll
Right.
also get the currency appreciation. And that's something that maybe we haven't talked enough about, is that we forget that globalization is this mega trend that's really pulling all of these countries into the global economy, into the world financial system. So the story of globalization is countries that are on the kind of periphery of the global economy as they trade more and invest more with the major markets, as they get baked more into the global system, their currencies become more fully valued, their assets become more fairly valued, and that creates the opportunity.
So would you bet on the rupee or the renminbi? I don't know.
I think the rupee
Rupee?
looks cheap. Both
Right.
of them are very difficult to kind of play. They're controlled markets. But I think that the rupee might have a little more upside over the long run.
This is where I think Peter and I actually differ. I'm a strong believer in the renminbi over the long run. And here's why. Going back into economic history, back in 1914, the most used currency was this pound sterling. But fast forward to 1924, it took 1 decade for the US dollar to overtake the sterling as the most used global currency.
1 decade, wow.
It took 1 decade.
Right.
And what happened in between was actually a world war,
Right.
as well as the establishment of the Federal Reserve System in the United States. And what we're seeing now in China is a very strategic and thoughtful approach to internationalizing the renminbi. In fact, the renminbi actually overtook the euro as the second most used trade currency. It happened just in October of 2013. Now, some of those numbers are maybe somewhat overstated because there are quite a few companies that have subsidiaries in Hong Kong that are based in China. So there's a lot of invoicing between the segments of the same company. But nevertheless, it really just goes to show how important the renminbi is, and the fact that the Chinese have been so strategic about internationalizing it, meaning they've been asking their companies to invoice in the currencies. They're also slowly liberalizing interest rates.
Right.
And as we all know, interest rates is the single most important allocator of capital. So I think over the long run, I would actually put my money with the renminbi.
So we'll have to ask you back in 20 years and see who wins this bet. But it's so great to have you. Teresa Kong from Matthews Asia, thank you very much for joining us. And Peter Marber, newly at Loomis Sayles, thank you very much for joining us as well on Wealth Track. At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is follow the advice of Sir John Templeton and buy in periods of maximum pessimism. I knew Sir John, and I know he would be scouring various emerging markets for the cheapest, most unloved, and depressed stocks available, and he would relish every minute of it. Where are investors most pessimistic today? Well, obviously, one answer is emerging markets. As our guest pointed out, they are not all created equal, and there are quality bargains to be had. Two other vilified and rejected investments are gold and U.S. Treasury bonds. Both have actually rebounded a bit during the height of the emerging market sell-off because investors go to them in times of trouble. They are living up to their reputation as excellent sources of diversification as they zig when other markets zag. So carefully start tiptoeing into these markets again and take advantage of Sir John's favorite investment activity, global bargain hunting. Well, next week, we're going to visit another unloved investment that is becoming more essential every day, municipal bonds, with Muni bond managers Rob Amadeo from Western Asset Management and Mainstay Funds' Bob DeMella. In the meantime, visit the extra feature on wealthtrack.com to see additional interviews we have done exclusively for our website. And for those of you on Facebook and Twitter, we look forward to connecting with you. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fairhome Foundation.